Good morning, Mike and David here on this day before July 4th. It's a short trading day, and I know I'm looking forward to a little bit of a break. So today's topics, we're going to talk about it's a presidential election year. How does the market perform in a presidential election year? And then how much do you save up to hit that goal? And you'll see the obviously the benefits of starting earlier. And then David's going to jump into a topic about, kids and how do we prep them for this future financial world, things that maybe you can do in the early years with them. But before we get started, I must remind you this is a financial education presentation. You must do your own due diligence on anything that you hear within this presentation. More disclaimer information can be found at ankerstarwealth.com. And the opinions expressed are mine and David alone. So let me start off with sharing my screen. And let's talk presidential election year. So our friends at First Trust sent me this. And what does the market return on average in the year that a president is elected? Now, certainly I don't want to go down the political side of this and say, oh, Republicans, it's this, Democrats, this. So we must elect a Republican because it pays more. I mean, that'd be crazy to say because the market returns most of that prior to the election. But overall, let's just look at the average return of 11.58%. Now, keep in mind that that number is calculated at the end of the year after the election has occurred in November. And the good news with that is the market wants clarity. It just wants to see that unknown removed. So now they know who is elected. Did the president do anything in their first 2 months in office to earn this return? Absolutely not. I mean, that's the stock market, the business, the earnings, all the things that happened prior. This just happened in this year. And one thing I'll say is that presidents take far too much credit and they pass or opponents pass way too much blame to presidents on the stock market. So the business cycles run independent of the election cycle, but obviously everybody likes to take credit. And when I look back at these past returns, and I think it's really interesting to look at 2020. So that was the year Biden was elected. That was also the COVID year. Earlier in that year, the stock market was down like 34%. And obviously lots of things happened. And by the end of the year on this, it was up 18%. So when you look at just up 18%, it sounds like, well, that's a great year, right? I mean, that was a crazy year. And then when you look back at other ones and take 2008, I see Obama and there's a big negative 37%. Was that Obama's fault? Oh, absolutely not. I mean, he came in, there was a financial crisis, things were going bankrupt. So it just happens to be next to his name. But, the key point out of it is we will have clarity. I do like where it says 83% of the time we have a positive performance in an election year, which is better than average. And certainly so far, 6 months into this year, it's been a great year so far. So we'll see where that goes. The next thing I wanted to hit real quick, and I saw this article, how much you need to save each month to retire with $1.46 million on a $50,000 salary. And first I'll start off with saying the earlier, the better. If you're trying to get to 1.46 and you're in your 50s on a $50,000 salary, well, maybe you're just not going to retire till you're 90. I don't know. But what I did like out of this was it shows different starting points and an annual rate of return. Now, obviously, you do not control your rate of return, but you do control your risk level. So if you're able to tolerate higher risk, you tend to get higher return with more volatility. So let's just look at these three different ages, 21, 25, and 30. And I'm really just going to look at the 9% rate of return. When the overall market, typically we can get 8 to 10%, or in some years, over 10 to 12 consistently. So let's just look at a 9% rate of return. So if you are 21 and you're watching this and you're thinking how much to save, first of all, great job. I'm glad you're starting to look at this at age 21, because the earlier the better. And certainly using a Roth IRA, you're paying tax at a low level now, and you won't have to pay tax at a level we do not know what it'll be in the future. But if you start at 21, $216 per month to hit that 1.4 something million. But just if you just wait 4 more years, it goes up by $100 a month for the rest of your working career. And then if you wait to your age 30, which is 5 more years, it's up another $200, almost $200 a month. So you can see the absolute importance of starting early. In fact, what I like to recommend, and I do with my own kids, is when they get that first job, that's the time to get that Roth IRA open and get the habit of putting something in, not all their money, but like putting some savings in so they can hit this kind of goal. And this is a good place here to switch it over to David and talk about, what are some lessons for young people? Since he's been in the teaching world, what are some things that we can teach these? I call them kids. Anybody more than 20 years younger than me as a kid, but they're definitely young adults.
Well, and that's a great question. Going back to your last point about convincing them to put money into a Roth IRA, that habit needs to be in place before they get there. So how do we get that habit in place before they get there? So I think when they're kids and they're around the house, teaching them to save birthday money or Christmas money that they get, put 10, 20% away, sit down with them, talk to them about why, go through what you're doing for them, whether it's a high yield savings account or something like that, where they can see the returns and stuff like that and see that their money is working for them. And another concept that I got that I thought was really cool was if they do chores around the house, that's a good opportunity to teach them how to negotiate a salary and talk about, okay, you're going to do XYZ this week and it's worth XYZ, and negotiate with them on, is it really worth that? And then teaching them to save off of the salary that you're paying them. It gives them valuable skills that they'll need when they are adults, and they're learning it as a child, which is my labor has value, and that I need to save some of what I'm doing. And so, how much you want to save, is it 10%, 15%, 20%, but building that habit when they're in middle school, elementary school, and then when they become teenagers, if they get a job, they have this skill going into the job. And so, if they're 16 and they're working, they can have a Roth IRA and start contributing. So that's an additional 6 years in front of what Mike just said, of being 22 or 23 when they come out of college and they get that first job and they start contributing to a Roth IRA. You can move that up 6 years. So if they're in the habit of doing that when they're 16 and then they come out of college and they do it, how much better off would they be? So just some things to control, because as a teacher, I always told my parents and people who talk to me now about, I have kids getting ready to go to school, what do you think? It's like, well, you should always be your students' first and foremost educator. And wherever you send them for school, you're using that to supplement what you're teaching them at home. But you're number one. And so just keep that in mind. They're watching you. They're going to mimic what you do. So, but if you can get out ahead of it, that's going to help. That's going to help them with their money later on and teach them those valuable skills. And when they're 30 and all of their friends are just learning this, they're 15 years ahead of the game, essentially. What do you think, Mike?
That's good. That's good. When you're talking about negotiating and chores, so first of all, I've got a bunch of kids. We'll say I have 5. So this is probably not the world's best parenting example, but it's fun for this conversation. So a few years ago, I went to one of my kids and I said, "Hey, you want to make some money and mow the lawn?" And they said, "Yeah." How much will I get paid? I said, "Well, how much you think you should get paid?" And they said, $20. And I said, "Well, that sounds pretty good, $20." And then his brother was sitting there and he was like, "Well, I'll do it for 15." And I said, Now we're starting to understand the labor market. I was
Yep.
like, 15. Talk to me. He's like, well, I'll do it for 15. And then the other one was like, well, maybe I'll do it for less. And I was like, I like negotiating this way. But then we have to bring in the quality aspect. It's
Right.
one thing to have your, 17 or 18-year-old mowing the lawn, and another thing to have your 12-year-old mowing the lawn. I don't know if the quality level, but I don't think they appreciate. I was ready to negotiate them down to like a internship mowing the lawn, for
For
experience.
free, yeah.
So
It's an interesting idea, yeah. I I think that's great. And the negotiating with the kids all being there, it's like, that's another. I never even would have thought of that. Yeah, that's a good idea
oh
too.
well, that's the reason to have more kids, because they cost you, whatever, $250,000 every kid you've got. That's the theory, but they'll save you, $5 mowing the lawn. Maybe that's not a good investment on my part. I don't know. I'm just kidding.
Yeah.
But well, thank you all for listening, and maybe we'll have some more tips. We could spend hours talking
Yeah.
about tips for kids in high school. And I know David said if they get a job. I thought to myself, when they get a job, you definitely want your kids to get some work experience of some sort. Don't make
Yeah.
their first job when they're 22 and coming into college, or
I
coming out
agree.
of college.
I
Get them
started
some work.
working. Yeah, I started working at 15.
Uh, I think I started 14 or 15 as well.
Yeah.
So,
At a
but
concrete
yeah,
company.
that's a great exercise and pay. That's the way
Yeah.
it should be. There you go.
So,
The old paper routes are gone. I know my daughter just the other day said, she goes, who puts that newspaper out there? Because I do get the Wall Street Journal. It gets delivered out front. And I said, yeah, they deliver it at like 4 or 5 in the morning. And she's like, really? Like, you don't get it out of the mailbox? I was like, no, somebody goes around and she's like, I've never seen that person. I was like, I didn't think you had.
uh,
So
how the
that that
times have
that is a
changed.
yeah, I was gonna say that is a job. So, and I do appreciate that person delivering it so early.
Yeah.
But all of you have a great July 4th, and I'm not sure
Happy
whether we'll have
Independence
a
Day.
show on Friday, but happy Independence Day. And just so everyone knows, tonight is the investors update for the third quarter, so that will be at 7:30 live. You can actually ask questions 7:30 Central Time live. So that's it. Well, thank you. Have a good one. Bye.
Bye.